Welcome back. This has been kind of a rough week for the portfolio, down more than 6%, almost $4,500. This was a huge week in terms of earnings for the portfolio, with PayPal, AMD, Elf, Uber, and Amazon all reporting earnings. Some of those stocks fell pretty significantly after their earnings. PayPal was down almost 13% on Monday after their earnings. I think that includes after hours. AMD was down 5% after hours. Uber was down almost 8% on Wednesday after their earnings, but they've made a pretty significant recovery since then. Elf was down a crazy 25% after hours, and Amazon was down just under 5%. So did I just pick losing stocks? What happened here? I'll explain that in this video and go through the different earnings reports. Starting with PayPal here. As I mentioned, PayPal was down a bit after earnings, which is kind of funny because I bought this stock as more of a value play for stability and predictable growth, but it ended up being pretty volatile after this earnings call. So PayPal beat revenue estimates by roughly 1.3%, and they beat EPS by 7.2%. If we take a closer look at the numbers here, total payment volume was up 7% year over year. It's okay. Revenue was up 4% year over year. Again, okay. Transaction margin dollar was up 7% year over year. Again, okay. But if we look at the transaction margin, which is all their revenue minus their transaction expenses, such as fees from card networks like Visa and MasterCard, any payment network fees, fraud and security costs, chargeback costs, bank costs, and partner fees. Also excluding any credit losses from credit delinquencies or people not paying what they owe on their credit cards, or the whole buy now pay later situation. But essentially, this metric is really a profitability measure and just tells us that the company is starting to increase their profit margins again after they were declining for a bit. You can see that the percentage is slowly going up here. Moving on, we have EPS up 5% year over year, which is not great, but there's a reason for that, which I'll get into in a moment. Free cash flow is down 11%, but on an annual basis, it's up significantly, 60%. Okay, so EPS was weak, and revenue was definitely weaker than we wanted. Revenue was still positive at 4% growth, but that's nothing to brag about. If you watched my very first video on this channel with my entire investment philosophy, you know that I'm looking for stocks that grow faster than the average stock in the market. This quarter, PayPal didn't do that. But if we go back and look at last quarter's earnings call and what Alex Chris, the CEO, said then, that will give us some context regarding this currently slow revenue growth. He said, for the fourth quarter, we expect revenue to grow by a low single-digit percentage. This is directly related to Braintree merchant negotiations and ongoing efforts to drive quality, profitable growth. As I mentioned earlier, this is a deliberate action and a continuation of the strategy we've articulated throughout the year, where we have accepted a lower near-term Braintree revenue profile in exchange for better margins as we have renegotiated agreements. As a result of these efforts, we expect lower Braintree volume and revenue growth in the fourth quarter and through 2025 before re-accelerating from the reset baseline. This is a healthy, profitable trade-off for the business that benefits transaction margin dollar growth and builds stronger, more strategic relationships. So if we look at the total payment volume broken down by segment, we can see that pretty much everything but the unbranded checkout segment, the Braintree part of the business, is growing and even accelerating. You look at these growth rates, they're all getting better or at least improving. But the Braintree part grew 2% this quarter compared to 29% in the same quarter last year. And this is a significant part of their business, making up anywhere between 35 and 36% per year of their total payment volume. And to explain a little bit what Braintree is, it's basically a white label payment platform, meaning companies can integrate the payment processing features and brand them as their own, even though it's technically powered by Braintree. Braintree processes transactions for Uber, Airbnb, DoorDash, and Spotify, and a bunch of other companies. So that deceleration in Braintree growth is the first thing that freaked investors out and caused some uncertainty. Uncertainty is something that the market hates, but also you have to remember that the stock market is very forward looking. In my experience, investors often only really care about the forward looking statements during these earnings calls. So, what's going to happen in the next quarter or the next year? And really, they look to the management team to give them guidance on that. So, earnings calls are usually broken down into three sections. First, the past quarter results. Uh, Second, the next quarter and full year expectations. Obviously, if a company beats their earnings by a ton, the management team will usually come in and adjust their guidance or expectations higher than they previously did. And the same goes if the company misses on their earnings by a lot, they come in and adjust the guidance lower. These two scenarios can cause the stock price to obviously explode in their respective directions. And the third and final section is usually the Q&A section, where analysts can ask questions and the management team answers them to the best of their ability. This often gives you more insight into specific parts of the business that aren't mentioned in the call or maybe not seen as well in the numbers. Um, it's also a good idea to pay attention to the management team's attitude during the call. Do they sound excited or confident, or are they holding back a bit? That can often be very telling. So the actual numbers were good. So what was so bad about the guidance or forward looking statements that caused the stock to drop by 13% on the day of earnings? And we'll look at if that was justified. So here's the second worry that analysts saw and investors saw during the earnings call. Analysts were expecting next quarter's and next year's adjusted EPS to be much higher than what PayPal said they were expecting. Here, PayPal says they expect to earn $1.11 to $1.13 per share for the first quarter and $4.80 to $4.95 per share for the full year, compared to the $1.07 first quarter and $4.67 full year estimate from analysts. However, the company said it expects adjusted earnings per share from $1.15 to $1.17 per share for the first quarter and $4.95 to $5.10 for full year 2025, well below the $1.36 and $5.83 per share analyst consensus. In PayPal's case, their total profits or EPS looks good, but when you strip out any extra costs and focus on their core business, which is what their adjusted EPS represents, it's weaker than what analysts expected. And investors care about this because it tells them how well the company is really doing without any one offs like special charges or cost cutting measures or something like that. The difference there is, again, largely due to the slowdown in Braintree growth. And when it comes to all those Braintree decisions, as I mentioned, that's their decision to drive more profitable growth instead of just any growth. And ultimately, I trust Alex Chris's judgment on that, which is why it's important to find a CEO and a management team that has a good track record and you trust to do the right thing for the company's long-term success. So regardless of the stock being down, 13% or so, I'm not buying or selling. I probably would be using this opportunity to buy more PayPal if my position wasn't already so big. But ultimately, I'm not worried. I bought this company because of its incredibly low valuation at the time and as more of a value play. That was back when shares were anywhere between $50 and $60 a piece. The company is still cheap with a forward PE of under 16. I'm not expecting insane growth like a lot of my other positions, but I do expect market beating predictable growth in the next few years. I'm hoping that will come back after the whole Braintree profitability situation is settled. But lastly, here's my biggest takeaway from this entire earnings call. PayPal announced that the board of directors have authorized a new $15 billion stock repurchase program. And this new repurchase authorization is in addition to the June 2022 stock repurchase program, which had $4.8 billion roughly remaining um, as of December 2024. So roughly $20 billion to buy back shares. For context, PayPal's market cap is currently around $80 billion. So if they hypothetically purchase $20 billion worth of stock at today's price, they would reduce the total number of shares outstanding by 25%. So hypothetically, your shares would be worth roughly 25% more. Obviously, as they buy more shares, the stock price is likely to continue going up, but when growth gets to a better place again, hopefully in 2026, and with such a large buyer in the market, earnings per share or their profitability could really scale up quickly. And again, with such a big buyer in the market, supply could outpace demand, driving up price. Next up, AMD. I just made a video on AMD, so I'm not going to go too much in depth on the products or explain the business too much. Check out my AMD video if you need to get caught up on the business. I go much more in depth in that video. But as I mentioned, AMD was down a bit after earnings, and I'm currently down just over 10% this week. So AMD beat revenue estimates by 1.7%, and they beat EPS estimates by less than 1%. So very narrow beats. But if we take a closer look at the results here for the quarter, they continue to grow revenue very quickly. It was up 24% year over year on a quarterly basis. Amazing, incredible growth. The non-GAAP gross margins improved to 54% as expected, which is good. And GAAP refers to generally accepted accounting principles, which every company has to follow when they report earnings. The reason we're looking at non-GAAP numbers is because AMD is able to exclude any acquisition-related expenses and any non-recurring expenses that aren't part of their core business operations. If we look at operating income, was up to $2 billion from $1.4 billion last quarter on a non-GAAP basis, which is driven by higher revenue and better gross margins. So it's again good. EPS was up 42% year over year. Amazing. EPS is outpacing revenue. Now, I'm not trying to bore you too much with mindlessly reading numbers, but rather focusing on the big picture and longer term fundamental trends here. So if we take a look at the revenue broken down by the different segments, you can see that data center revenue was up 69% year over year. Their data center and AI business is growing the fastest, and it's now almost half of AMD's revenue. So when you compare the quarterly year over year revenue numbers to the annual year over year revenue numbers, that's 24% growth quarterly and 14% annual growth. You can obviously see that most of the growth came during the second half of the year, and it just shows that they have their different segments built out, and now they're scaling them. So as data center and AI continue to grow next year, and that's already driving the large majority of the revenue growth here, and the gaming and embedded segments get back on track, the revenue growth could explode higher on an annual basis. So that leads us into the future expectations for AMD. Here's what the management team said. Turning to our first quarter of 2025 outlook, we expect revenue to be approximately $7.1 billion plus or minus $300 million, up 30% year over year, driven by strong growth in our data center and the client business, more than offsetting a significant decline in our gaming business and a modest decline in our embedded business. And I'll say it again, if you've heard anything about the earnings from the big tech companies, they're spending record amounts of money on capital expenditure, primarily AI infrastructure, which puts AMD in a really good position moving forward. Lisa Su, the AMD CEO, also touched a little bit on DeepSeek and her vision for the future. Obviously, DeepSeek has kind of thrown a wrench into the whole demand for chips theory recently, but she gives her perspective on that. She said, for 2025, we expect the demand environment to strengthen across all of our businesses, driving strong growth in our data center and client business and modest increases in our gaming and embedded businesses. So, as I said earlier, we could really see that annual revenue growth increase. Against this backdrop, we believe we can deliver strong double-digit % revenue and EPS growth year over year. Looking further ahead, the recent announcement of significant AI infrastructure investments like Stargate and latest model breakthroughs from DeepSeek and the Allen Institute highlight the incredibly rapid pace of AI innovation across every layer of the stack, from silicon to algorithms to models, systems, and applications. These are exactly the types of advances we want to see as the industry invests in increased compute capacity while pushing the envelope on software innovation to make AI more accessible and enable breakthrough generative and agentic AI experience that can run on virtually every digital device. All of these initiatives require massive amounts of new compute and create unprecedented growth opportunities for AMD across our businesses. AMD is the only provider with the breadth of products and software expertise needed to power AI from end to end across data center, edge, and client devices. We have made outstanding progress building the foundational product, technology, and customer relationships needed to capture a meaningful portion of this market. And that shows Lisa Su is positioning this company to offer end-to-end solutions for clients. Um, and we believe this places AMD on a steep long-term growth trajectory, led by the rapid scaling of our data center AI franchise for more than $5 billion of revenue in 2024 to tens of billions of dollars of annual revenue over the coming years. So why is AMD down? This all sounds so amazing. Well, from what I can tell, Wall Street was expecting more from the AI business and felt that 9% growth since last quarter wasn't good enough. My opinion, slightly lower than expected, but whatever. I'm looking long term here. I bought more shares on Tuesday after the drop. I bought around 15 more shares, and I remain extremely bullish on the company. Speaking about long term, as I mentioned in my previous AMD video, it's important to understand the difference between training and inference GPUs. I mentioned then that the future growth opportunity could be better for inference as all these models get trained with the training GPUs. Inference GPUs focus more on executing and reasoning with those trained models rather than training the models themselves. So, when these models are deployed for real world applications, inference GPUs will be used. The point is, the majority of AMD's current GPU sales are all inference. Um, so we already know that companies like AMD's inference GPUs, which is positive. Anyway, Mark Zuckerberg touched on this point recently. This article highlights on January 29th, Meta held a conference call with analysts about its fourth quarter of 2024. When Zuckerberg was quizzed about the potential impact of DeepSeek, he said it's probably too early to determine what it means for capital investments into chips and data centers. However, he said even if it results in less capacity requirement for AI training workloads, it doesn't mean companies will need fewer chips. Instead, he thinks capacity could shift away from training and toward inference, which is the process by which AI models process inputs from users and form responses. Many developers are moving away from training models by using endless amounts of data and focusing on reasoning capabilities instead. I just wanted to bring that to your attention. This is just another perspective on the whole DeepSeek impact on AI infrastructure and the need for chips, like we've been discussing and really thinking about for the past few weeks. Up next is Uber. Uber was down after earnings. As I mentioned earlier, it was like 8% the day after earnings. But as you can see, they bounced back pretty quickly and they're up now 14% this week. Uber beat revenue estimates by 1.7% and beat EPS estimates by 542%. So a strong beat. If we look a little closer at the numbers they reported here, as we've been talking about, even at Uber's massive scale, this company is still a growth beast. Anyway, as I said, I don't want to mindlessly read through these numbers. The overall story is Uber is still growing revenue 20% plus. They're growing profitability. They're growing monthly active platform users. They're growing their new, relatively new Uber One subscriptions. And they expect all that to continue, basically. They have leverage in their business model because they're asset light, which is a characteristic I always like in my companies. That leverage comes from the fact that it costs them so little to continue to generate revenue. It scales, or revenue scales, almost without any additional cost, and that's really powerful. And because of this, both their EPS and free cash flow exploded. If we take a look at the same quarter last year, they earned 86 cents in EPS. In the quarter this year, that increased to $4.58. Even just like quarter to quarter, that's massive growth. If we look at the free cash flow here, it's the same story. I mean, just look at this free cash flow growth, over 100% year over year. What I realized during this earnings call was that my thesis and what I've been thinking in terms of the future of this business is exactly in line with what the management team thinks. And that's great growth in revenue, which is translating into profits and free cash flow. And they're using that free cash flow to buy back shares at these cheap valuations, which is what I said recently I was hoping to see more of. And the AV or autonomous vehicle providers aren't as big of a worry as most investors seem to think, at least recently. By the time AVs are commercialized, there are going to be many more players than just Waymo, and one of them is bound to tap into Uber's giant network, in my opinion, especially since Uber partnered with NVIDIA to advance AI AV development. I mentioned in my Uber video that I saw that as sort of a defensive play by Uber to ensure that there are a ton of players in the market and they have more than enough providers to work with. But just so you don't have to listen to me restate everything that the management team said on this earnings call again, let's just take a look at the CNBC interview that the Uber CEO Dara did. He sums it up pretty well in there.
Uber CEO Dara Khosrowshahi joins us exclusively here at Post 9. Look, I'm going to start, Dara, with what I regard as being important, which is gross bookings. That's always been the number I've measured you by. They seem to be pretty good, but maybe you can disabuse me of that.
Well, I think they were pretty good. We actually saw acceleration. Usually as companies get bigger, they slow down growth. We saw acceleration in gross bookings, 21% on a constant currency basis. It was driven by trip acceleration too. Trips grew 18%, faster than last quarter. And really it was driven by audience. More and more people are coming to Uber on a monthly basis, over 170 million monthly active platform consumers, again, accelerating on a year-on-year basis. And we're able to grow the top line while growing the bottom line. Adjusted EBITDA of $1.8 billion, up 44%. For the past year, we threw off almost $7 billion of free cash flow. And we're putting it to work buying back stock aggressively as well.
Okay, and that's very important because people might say, wait a second, why are they doing that? The operating income looks like a big miss. But when you dig down the operating income, you realize that there is a very big legal issue to make it so that is not the metric that we should be focused on.
Well, I think what we do is we try to estimate as best the legal reserves going forward. It's not a part of day-to-day operations. And again, I think the truth is in cash flow, so to speak. And the
Right.
$7 billion of cash flow that we delivered on this last year is the biggest number ever, and we think it's going to continue to grow going forward.
Do you think, before I turn over to my colleagues, that there's still a belief, even though Waymo's doing 150,000 a week, which I'm still thinking is not all that big, that there is an existential threat from autonomous vehicles away from you, and that could be some sort of overhang where people are saying, I'm scared?
Well, I think autonomous introduces both uncertainty and a huge opportunity for us. If we look at the U.S. market, for example, we think autonomous alone in the U.S. can be $1 trillion market. And the tech is definitely getting there, but the commercialization is going to be much more challenging, right? To be able to deliver autonomous at scale. For perspective, we're doing 33 million trips a day, right? Those are the kinds of scale that we operate at. And a bunch of stuff has to come together. First, the regulatory environment has to get there, right? And it's national regulation, state regulation, city regulation. It's going to take some time because regulators need to get comfortable with this new technology that's operating in the streets. Cost of a mistake is really high. Second, what you need is a superhuman safety record. Like, the opportunity that you have with these robot drivers isn't just to be better than humans. They could be multiples times better than humans. And I think the industry should take that opportunity and increase the bar on safety appropriately as a result of this incredible opportunity. Third, you need to mass produce these cars affordably, right? It's not about 100 cars or 1,000 cars. You need hundreds of thousands of cars. That is going to take a while, and the OEM industry is definitely taking notice. They're investing. But, these vehicle platforms takes years to develop. Then, once you have the vehicles, you need to operate them on the ground. Fleet operations, it's a ground kind of game. We're very familiar with that. We already have fleets all over the world. And then you need really high utilization because the cars are expensive. You need to operate them at high utilization both during peak times and during troughs as well.
Right.
The only way you bring all that together, this commercialization, is with Uber and the AV industry. It's going to take a while. As that time passes, you're going to see a lot of autonomous players coming in with these big transformer models, with the DeepSeek moment that we saw. The development of this technology is going to be cheaper and cheaper and cheaper. But we think that with the safety promise and with a partnership like ours, we can build autonomous to be a very, very big business.
You obviously have thought a lot about it, but we are getting a real-world test case in San Francisco, and I'm curious as to what you're seeing because Waymo seems to be doing fairly well. Are you losing share, or are people driving less?
You know, it's actually interesting, and this goes to the scale. Waymo's doing a great job. Terrific partner. We're going to launch with them in Austin and Atlanta. In San Francisco, actually, Q4, our growth accelerated on the mobility business versus Q3. So it's just too small at this point to make a difference in the overall business. And this isn't like globally. This is just in San Francisco.
Right.
Phoenix, our business accelerated. LA, our business accelerated.
So you'd expect the same for Austin and Atlanta?
I think in Austin, Atlanta, it's going to come
be your business anyway,
network.
right?
And so we absolutely do think it's going to accelerate because it's going to be a different product coming into the Uber ecosystem. And one of the ways that we have grown is building out all kind of innovative new product. You know, Uber for business, low cost, two-wheelers, three-wheelers, share, high capacity vehicle. Autonomous is going to be another choice. And I think what you'll see in Austin and Atlanta is the uptake of AV is going to happen at a very accelerated pace. And what we've seen in Phoenix is our customers love the product. So what's wrong with that?
So he sums it up really well in that video. I'm more bullish than ever on Uber after this earnings call, and I think I need to buy more shares as soon as possible. Next up is Amazon. I'm not going to spend too much time on Amazon here because they're not really in any sort of transformative period like all of these other companies I'm covering today. Amazon is just doing what Amazon does. They grow. As you can see, the company was down slightly after earnings. I think it was around 5%, as I mentioned at the start of the video. Amazon did beat revenue estimates slightly by like 0.3%, but they did come in and beat EPS by more than 22%. So strong quarter from Amazon. If we take a closer look at the numbers, net sales increased 10%. Operating income increased to $21.2 billion in the fourth quarter compared with $13.2 billion in fourth quarter of 2023. The future guidance was 5 to 9% year-over-year growth in net sales for the next quarter. This is what investors didn't quite like about this earnings report. These are pretty low numbers for Amazon standards. So you got to ask yourself, could the large numbers just be catching up with them? Because even a 5% increase in sales for Amazon is billions of dollars on an annual basis. Or is Amazon signaling trouble in the near future, like a recession or decline in the economy? I don't know. We'll just have to see. But this company just grows and grows and continues to execute well. It's just not one I want to miss out on. Some other highlights they included were they delivered at the fastest speeds ever for Prime members in 2024. They delivered over 65% more items to U.S. Prime members the same day or overnight than in Q3 or Q4 2023, and this will only increase people's reliance on Amazon and their convenience, in my opinion. Record-breaking Black Friday and Cyber Monday sales, and all that while delivering the lowest prices, being named lowest priced U.S. retailer by Profitero for the 8th year in a row. An average of 14% less than other major U.S. retailers. They also launched Amazon Haul to fight off the Temus and AliExpresses of the world to kind of battle that ultra-low pricing. They signed new AWS agreements with the U.S. Army, Intuit, PayPal, and a ton of other big companies. So everything continues to head in the right direction for Amazon. Next up is Elf. What a disaster the stock price was this week. They're down over 33%. I bought 2 stocks on Tuesday. One of them was AMD and the other was Elf. So 25% of my $1,300 that I put in ELF on Tuesday was literally deleted in a week. However, I do think ELF just became my number one buying priority as long as the stock price stays at these low levels. Like, I might honestly look through my portfolio and try to figure out what I can sell to take advantage of this drop. I've been thinking I might even do something rash like selling all my Nvidia. Um, as you might know, my big bet on AI chips is already with AMD. I do think Nvidia comes at a higher valuation, and I see ELF as a better risk reward over the next few years. So I might do something like that. Uh, Join my Discord. I post all my buys immediately in there. So if you want to be notified when I make these buys, be sure to join me in there. So ELF actually beat revenue by 7.5%, even though this here says that they missed. This was the expected number, and they came in with that. So they beat by 7.5%. In terms of EPS, that's where they missed slightly by like 2.6% or so. Let's dive a little deeper. I'm just going to go through this earnings presentation with you. First off, this quarter's results. So 31% net sales growth, $69 million adjusted EBITDA, 220 basis point market share growth. And that's just a fancy way of saying 2.2% market share growth. Now, if we look at the growth record for this company, 24 consecutive quarters of net sales and market share growth. That's 6 straight years. They're one of 6 consumer companies out of 546 to grow 24 consecutive quarters while averaging 20% plus growth, which is insane. And they're one of 1 cosmetics brands out of 988 to gain market share for 24 consecutive quarters. So this company continues to grow across the board. Now here's what sent the stock down, 25% plus during the after hours after earnings. Future growth expectations of 14 to 16% for the second half of fiscal year 2025. That's compared to 77% growth seen in the same period last year. The cosmetics industry has been struggling since consumers suffered from inflation recently. However, compared to other cosmetics companies, these numbers and projections are great. Other companies are struggling to even grow at all. Going back to the point of struggling during a weaker economy, I'm going to make the same exact point as I made in my last video. ELF's products are priced so cheaply compared to other products in the category. So obviously people will continue to need makeup. So which products are they going to buy to save money in a weaker economy? Obviously ELF. And they provided more growth numbers. ELF was number 1 in unit share of mass cosmetics last year and number 2 in dollar share. However, they were number 1 in dollar share in Target, and ELF continues to grow their share in both Target and Walmart. Basically, their products are selling and much faster than other brands in those stores. Skincare has been a big focus for the company over the past few quarters, and according to Nielsen data, which is basically just credit card data that gives us insight into consumer spending, ELF Skin grew from the 25th position to the 10th position in this category. ELF also outperformed that category, and that's important because the skincare game could be even bigger than the cosmetics game. Men and women use those products, and they use them every day. Moving on to the international business. International net sales growth was 66%, and they expect that part of the business to grow significantly over time. They're constantly moving into new markets and into new retailers in those markets. Another important thing to note is that they're the number 1 most purchased products by Gen Z, millennials, and Gen Alpha. If they can keep that up and keep those customers around as they grow older, ELF could really become the next big cosmetics giant. We'll have to wait and see, but this is super important in my opinion. Lastly, there have been big concerns about tariffs recently. I mentioned in my last video that since those tariffs on China were only a 10% additional tariff, I made the point that since their products are priced so cheaply, they can literally just pass that fee on to the consumer without most people even noticing. Who's going to notice or care if they pay $7 versus $8 for a product when the competition is basically selling that similar product for double that? Not many people, in my opinion. So they mentioned price increases here. They also mentioned that they could try to negotiate better pricing with suppliers. or take cost saving measures while these tariffs are in effect. And maybe that would look like slightly less ad spend or reducing the number of employees, etc. And then they also mentioned international growth. These are US tariffs. They don't matter for products sold in other markets. And we see that those other markets are growing incredibly fast. To summarize, Alpha is a company facing short-term negativity, just like every other cosmetic company, but just not nearly as bad. This is a case of investors freaking out because growth isn't as strong as it previously was, but at a forward PE of roughly 18 today, and with growth that I expect to return in the future quarters, this is, in my opinion, one of the most attractive companies to buy out of all of the companies that I currently hold. They're still focused on taking market share and becoming the brand for consumers moving forward. And just think about what could happen if they start raising their prices when they're finally a bigger player in this market. Their profitability could increase significantly. And if we look at the runway of growth for this company, ALF currently has around a $4 billion market cap here at the bottom. Look at the billions of dollars of market share they have the potential to take over the next decade or so. But overall, it wasn't a great week for the portfolio. But as I said, a lot of these things that we're seeing are short-term focused, in my opinion. The long-term picture remains intact, so this is just a buying opportunity for me. If we zoom out on a 3-month basis, we're still up. Overall, we're in the green by quite a bit, but I expect the rest of 2025 to really look like this with Trump in office. There's a lot of talk of tariffs, there's threats, there's uncertainty, so I'm expecting a lot of this, but as always, I'm thinking 5 years in the future, so these are all just buying opportunities, in my opinion. Let me know what companies you're buying this earnings season in the comments below, and that'll be it for this time. See you in the next one.